Hello and welcome. Today we're joined by Stephen Yu, who is the lead fund manager at Blue Whale Growth Fund. Thank you very much for joining us today.
Thank you, Catherine.
Can you start by telling us about the impact that COVID-19 is having on the markets?
So the financial market is in disarray at the moment, and I think to us it brought back a lot of memories of the 2008 situation when we had the global financial crisis. And obviously COVID-19 is in health issues, but then the likely scenario is going to tip the global economy into a recession. We probably have already started a recession, but I think the key question to ask is what is going to happen to the world economy when we come through from this crisis, like when the coronavirus, the threat of the virus is going to be much less going forward. I think there's a lot of questions to be asked.
And what do you think the answer is to that? What do you think is going to happen to the global economy?
I think to start off with, the global economy is definitely going to take a big hit on the back of this, in particular in sectors such as hospitality, events, cinemas, travel and leisure, hotels. You would expect that people are not going to spend a lot of money in those sectors anymore going forward, or at least over the next 12 to 18 months. And unfortunately, I think those sectors do employ a lot of people in the sector. Hence, you would probably expect a lot of people might be out of jobs in the next 12 to 18 months. And I think on that basis, people become poorer, which means people spend less money in general. And that would be a lasting impact for the economy. So we probably would be, I think, if you look at the financial market, I think the market always anticipate what's going to happen in the near future, and it does move at a very fast pace. But in the economy context, it does take a long time to see the real impact. And by the time we get there, then it would take a long time to get out from this recession.
And how do current events compare to the financial crisis of 2008?
I think it's a very, very good question to ask. I think the look and feel of the current situation in the financial market, it seems to be quite similar to 2008. I think to start off with, the volatility in the market, the daily movement in share prices and stock market indices, I mean, you could be talking about plus minus 10% in a single day. I mean, that is quite excessive move. But and also at the same time that in 2008, the stock market, the S&P 500 in 2008 fell by about 50% in a year. So I think that number is quite a big number. We are now, the stock market now has already fallen by about 25 to 30%. So I think there's a lot of similarities. But I think the question for us, being financial analysts, is we will be asking what might be the similarity and what might be the differences. I think to start off with, the differences would be that looking back in 2008, we had a global banking crisis. There had been a lot of major banks failing, going under, getting bailout by the government. Secondly, we had a property bubble burst, which basically take a lot of consumer into negative equity through their mortgages. So when you have the two things working together, then the deleveraging effect from this is going to be quite significant. Also, at the same time, when we were going into the crisis in 2008, the interest rate was much higher at about 4% in early 2008. So I think that bit, we're not seeing that at the moment. I think what we have now, which are the difference, is we have the central bank being quite proactive in cutting rates. I mean, Bank of England already reduced the rates to 25 bips, and then we have this the Federal Reserve reducing the rate to about 0 to 25 bips, and at the same time you have a lot of central government around the world trying to do fiscal stimulus and to probably put money back to people's hand. And I think at the same time that we do not feel that there's going to be any major banks failing. At the same time, I think during the crisis over the last few weeks, the oil price collapsed on the back of the disagreement between OPEC and Russia. So now people who would probably, if they want to spend money on petrol, I mean, they will be paying less money now. So I think the financial condition today is better than before. But we are probably dealing with something that we have not dealt with before. So I think it's fair that the market's already down about 25 to 30%. But if you ask us whether we would see, is it going down I mean, is the real economy going to suffer the similar impact as 2008? We would suggest would be less.
What do you think the impact's going to be on the wider economy and individual companies?
I think this is a very important question to ask because we always look forward. So, of course, I think as we are sitting here today, it's very important that we invest into companies that we feel that they are not going to be impacted as much versus other companies such as if they are in the travel and leisure sector, if they are airlines, if they are highly indebted companies, etc. So I think in today's scenario, it's very important that we invest into very high quality businesses with strong balance sheets so they can sit through this. But the question to ask is what happened this time next year in 2021? Are all of the companies that I've just suggested are going to make a comeback or fully recover? I think the answer from us would be a lot of companies are not going to come back from this. I think firstly, there's a lot of companies that are quite highly indebted going into this crisis. I think some of these companies would disappear or go bankrupt. And of course, I mean, you would have a lot of people losing their jobs on the back of this. And then secondly, I think a lot of sectors that if they are for the likes of, let's say, high street retailers, maybe cinema, cruises, I think even you can argue that hotels who would probably be making money on the back of companies hosting exhibitions, etc., you would probably expect that might be a change of behavior going forward. So which means that this time next year or maybe 2 years from today, you would expect companies are quite happy to have their employee working from home. People might be quite happy watching their Netflix at home, having their movie streamed to them straight away without going to the cinema. And so I think there's a lot of implication on the back of this. And I think some of these sectors or sub-industry might not recover from this. And hence, I think when we talk about the markets or the companies, it's very important that investors are going to be very selective in terms of what company they are going to invest into. And a lot of companies are not going to fully recover on the back of this.
How bad do you think that the current situation could get?
I think that's a very difficult question to answer. We definitely do not feel that we have a crystal ball to call the bottom of the market. But I think I alluded on earlier that if we use 2008 as a benchmark, that the financial market, I mean, we're talking about the stock market here, fell about 50%. As of today, we're down about 25 to 30%. If you ask us, we don't feel the situation is as bad, or maybe the recovery is going to be as long, because at the time in 2008 that you have not only you have the banks deleveraging, which means that they're not lending money to small businesses or renewing their loans, etc. At the same time, you have the consumer crisis, which no one have any money to spend. I think in today's terms, I think people have a bit more money. I think the property market are still quite healthy. I think I did suggest that some people are going to lose their jobs. That I think that's part of, that's a normal course of a recessionary scenario. But I think we are in a better situation now. So if we have to put a number, we probably would say, I mean, we don't actually know the number, but we probably say maybe the worst we could get to maybe is 50%. So we're now down about 25, 30 anyway already. So that's another maybe 15% to go. But of course, I mean, there's also a chance that we don't get there because the situation, the real impact to the economy would be less than last time. And also the recovery would probably be a bit faster if we do come through this.